Hello and welcome everybody to the March Markets Monthly. I'm excited to be here with Gary Quinzel, our Vice President of Portfolio Consulting. My name is Doug Huber. I'm our Deputy Chief Investment Officer. I'm excited because we have a lot to talk about. Markets have been particularly turbulent to start the month of March. And so I think if we want to jump forward one screen here, we can get into kind of what we're seeing and what the investment team is thinking about. Since touching a high on February 19th, the S&P 500 has officially entered correction territory after declining 10% last week. It has subsequently rebounded a bit, but there's a lot going on that is affecting headlines and sentiment and driving a lot of this market volatility. First and foremost, we've had a lot of back and forth on U.S. trade policy, and we'll get into that a little later here, but that's starting to weigh on consumer and business outlook. And as such, people are starting to get concerned that maybe future growth is going to be impaired a bit from here should these tariffs take place and take place in a material way. Additionally, we are battling against some inflation measures. That is still a very hot topic as market participants look to those inflation numbers to try to gauge how the Federal Reserve is going to react with their monetary policy. And so there's particularly close attention to not only what today's inflation numbers look like, but those potential impacts of how tariffs might impact inflation from here. I think another issue that might not be noted here, but we will talk about, is labor markets. That has been a hot button for the Fed of how are our labor markets looking, and I think we'll touch on that as well. So, with that as a backdrop, I'm going to throw it over to you, Gary. Maybe we could talk about why we're expecting volatility to remain a little bit more elevated and what are we actually seeing in the market so far this year.
Thank you very much, Doug. And let's go ahead and dive on into the market update. It's been nothing short of exciting, right? In one perspective, right? If you look at the turnaround of the market performance that we've experienced, and we've used this chart now for a few months now. I think it does a really nice job of, comparing the quarter-to-date performance relative to the one-year performance, and we're seeing a notable shift, right? And Doug already pointed out, we use the term correction. Generally speaking, when a market falls more than 10%, we technically hit that a few days ago from the February 19th high. Markets have rebounded a little bit, but let's take a look at the difference in performance of, say, the S&P 500 quarter to date versus the 1 year. And you see some really more notable changes when you go across the spectrum. You start looking at small caps. And the really big takeaway, the one thing that's been quite interesting, is the notable recent outperformance of international markets, something that we haven't really talked about much, really, frankly, over the last few years. We're seeing a little bit of an appreciation of the euro relative to the U.S. dollar. A lot of that is based upon the things that are happening here in the U.S., based upon fiscal uncertainty. So we are seeing a little bit of a rotation there. Some of it might be short-term in nature. Some of it just might be really a reversal of some of the sentiment and the overvaluation that can impact markets over a very short time frame. We even saw some different performance in value relative to growth. We're seeing some of those high-flying growth stocks that have performed really, really well over the last several years, being some of those stocks and sectors that actually are the most to pull back in recent days. So a lot of it has certainly been sentiment-driven. There's probably a lot of technical factors associated as well. A lot of the trading, as we all know now today, is electronic or in dark pools and different high-frequency traders. So a lot of these things can pick up a lot of steam, right? When you have some of these elements of uncertainty that are elevated and the momentum picks up. And that's really what we're seeing over the last couple of weeks. We're seeing some of these top trades that worked really well. Those are the ones that reverse the most. If we shift a little bit towards fixed income, we are seeing some movement in yields in the right direction. We keep it there just for a minute, then I'll talk about the timeline. We're seeing yields actually pull back from some of the levels that we saw recently earlier this year. We saw the 10-year yield, which kind of climbed up earlier this year. It was up around 4.8% in early to mid-January. Fell as low as 4.15, pulled back a little bit, around 4.3 today. That's helped drive fixed income performance. And we've seen the very policy-sensitive 2-year yield. Policy-sensitive meaning it's very highly related to what the Fed is doing or talking about doing. That fell from around 4.4 to as low as 3.9. So that pullback in yield has actually helped drive performance of bonds. And that's something that, again, we haven't seen a lot of because we've seen, challenges on the fixed income side of performance. Instead of stocks, we're seeing a little bit of a reversal of that in the first couple of months, first quarter of 2025. Now, if we go to the next slide, I'll just kind of walk you through a little bit of a timeline of some of the things that have happened. So it's been quite interesting. And for those of you that have joined us in previous webinars, we talked about the animal spirits that kind of lifted the markets. When President Trump was elected, a lot of hopes of, lower taxes, deregulation, business-friendly environment, that all boosted the markets. And we had actually very elevated high levels of investor sentiment. That's actually, of course, pulled back. Now we've had multiple events occurring. We had some hawkish comments from the Fed starting in December of last year. You followed that with some AI jitters, and DC came to light. And then, of course, the tariffs that Doug talked about are the latest issue that's really caused a lot of uncertainty. And that's just been the key word that's really been a weight on stocks, is that heightened level of uncertainty, whether you're talking to business leaders, consumers, or even policy leaders. There's just a lot of uncertainty about what's going to happen next. And so thankfully, we have seen a little bit of a reversal in some of the markets lately, but I do think that uncertainty is going to likely persist for the coming months. If we jump to the next slide, I want to talk a little bit about volatility, because I think this is another interesting measure. This is the VIX index, and the VIX index uses option pricing as opposed to options trades. So in other words, the way it actually spits out the reading that you're seeing, it's based upon the current prices of what options dealers are quoting. And so what you've seen here, you saw that notable spike back in August of 2024. If you recall, that was spurred on by a weak jobs report, and there was an unwinding of the Japanese yen trade. That was one of the highest, if not the highest spike of VIX that we've had in recent history. Flash forward to December, we saw another very high spike in the VIX. And again, you see how straight up that line went. It was a very, very fast exogenous event that just occurred. But notice how the VIX ascent this time has been more gradual in nature, as all of those culminating events that we just talked about have led to this heightened uncertainty. So this is one of the reasons why we think investors, not necessarily should be worried, but should be prepared for higher volatility because of the way that volatility appreciated this time around. I'm going to pass it back to Doug. He's going to dig in a little deeper on some of the macro elements that are contributing to the overall environment. Doug?
Yeah, thanks, Gary. And I think, what you just touched on there is very relevant, right? Confusion and lack of clarity lead to volatility, and that's happened time and time again. And I think to the chart you just showed, it has been this kind of steady news flow of headlines that come out that are pretty big and impactful in nature, but with not too much clarity around how are they effectively going to be put into place. Are they going to be put into place? Are they jockeying for position? Is this a bit of a posturing on the administrative behalf, or is this really going to hit the economy? And I think everybody's trying to figure out, A, is it going to happen? And B, if it does happen, to what magnitude does it happen and how does it affect things? And so it's that confusion, it's that lack of clarity that creates that volatility. And if we go to the next slide, I mean, this is a great example of just how much uncertainty is out there. You can see that, this is a very fast moving measure of economic policy uncertainty, but I think it's a good visual to just show that market participants are really unsure of what is going on from an economic policy standpoint. And I think this is just one of the many pieces of the mosaic that lead to why that volatility is higher. And I think if we go to the next slide, I think this is a great area to talk about what is going on and why is it a potential sea change from what we may have experienced for the last 35 plus years. So just to take a step back, this chart is obviously showing our trade deficit. And you can see that we've reached kind of an all-time high and kind of how much we're running from a trade deficit perspective as of the end of last year. But let's rewind for some revisionist history here of starting in the 90s, right? The U.S. moved to a point where we were consistently running trade deficits, meaning that we were importing more goods and services than we were exporting. And the role with it, the idea behind that was we will move some of our supply chain and manufacturing processes overseas to places that we could find cheaper labor and production costs. In exchange for running that deficit, the agreement or the handshake was that these countries would buy our debt. That allowed us to issue more debt cheaply, and those countries would commit to buying our debt. And so that has led to us not only having an ongoing deficit, but also growing our national debt. What's happening today is essentially posturing to take us out of that program that we've ostensibly been in for 35 years at this point, saying, hey, we actually want to re-onshore all of our production. We want jobs here. And now the agreement is kind of getting turned on its head. And I think people are really trying to understand, what does that mean going forward? You've seen things like what's being called the Mar-a-Lago Accord, where we're saying, okay, maybe we won't import as many goods, but we can offer you defensive protection in exchange for you buying our debt. And so there's that combined with the impacts of what actually happens to our goods and services. We know that agreements with Canada and Mexico and China have been at the forefront of the tariff positioning so far. The European Union's just starting to kind of get in the headlines as we start to tax alcohol and champagne and other things that are coming from Europe. But I mean, it could be a material impact should this trade war extend over a long duration, right? We know that the average cost of an automobile could go up $3,000 to $6,000. The average cost to build a home, I think I saw, was maybe $10,000 plus more dollars. And so that's what economists and market participants are trying to figure out is, okay, if there is going to be a sea change in how the US deals with global counterparties, what does that mean for our economy? What does that mean for the growth side of the equation? What does that mean for the inflation side of the equation? Two things that we have kind of been on a razor's edge with for some time to begin with. Now as it's coming to the forefront with all that uncertainty. And so what is the market doing? And if we go forward one slide, we've gone from a position that after, Gary mentioned those hawkish comments back in the fall that the Fed was indicating, hey, maybe inflation isn't quite under control from our standpoint. We might not be cutting rates at the pace that you thought we were going to. And so as of January of this year, the market was really looking or predicting that the Fed would probably cut once for the year for 2025. But now that we're looking at a scenario where the market's starting to price in a much slower growth scenario, and there could be, potential ripple impacts to labor markets, which I know Gary will touch on in a minute. And the U.S. consumer, which has been such a big driving engine of the economy over the last several years post-COVID, if those start to get impacted, then now the Fed will have to step in and potentially move to a more easing monetary policy to combat some of the negatives of a decelerating growth environment. And so just in the span of 2 months, the market has gone from predicting, just about one cut for the year to predicting close to 3.5, maybe as many as 4 cuts this year. And so it's that rapid kind of movement of market sentiment that has really been throwing the equity and fixed income markets volatility higher and moving them around at a faster pace. And I think what we're trying to ascertain, and as well as all the other market participants, is what does that actually mean going forward? What will be the impact, and are our risks appropriate where we want to take them? And so we'll get into a little bit of that. But Gary, why don't I shoot it over to you to maybe get a little bit more granular on that U.S. consumer piece, on the labor piece, because those are, we know, two of the biggest things that the Fed is keeping an eye on.
Absolutely, Doug. So, I think if we jump to the next slide, we have this macro dashboard, and I know it's very, very busy, and you probably have to put on your readers to see all this. So I'll try to make some sense of all this. And I think put another way, what Doug he described it very well, but I think the key question we're all trying to figure out right now is just how much the impact is going to be both in the short and the long run. And I think there's a growing, or a popular consensus belief that a lot of what's happening right now is going to cause a lot of short-term pain, but it might not be that impactful over the long run. In other words, we're just shifting the balance of what's most impactful. And we think that some of the things that we're seeing right now, like, yes, it's going to hurt. It's impacting consumer sentiment. It's impacting household income expectations. And that's, if you look at some of the things that have turned over that are the most negative in the short run, you'll see some of those things that are affecting sentiment. And that's definitely having a real impact on consumers and those that are in a position to impact businesses. So, Job openings is another one that we're watching really, really closely, because if you look, that's one of the areas that has been the most read in terms of the number of job openings, which is actually a very leading indicator when looking at the overall health of the labor market. So we're seeing that as a more negative thing, and it's very impacted by the overall sentiment that's happening right now because of all the uncertainty, because of the complications associated with not knowing what tariffs are going to be, not knowing necessarily what our relationships are going to be with our partners overseas. And so there's just a lot of confusion right now, but there's also still this growing opinions out there that a lot of these things could just shift the balance to a different type of situation where we're not necessarily relying on trade the way we used to be. We're actually have more security because of, doing more production onshore. So very confusing time. It's displaying itself in the economic data that we have here, and that's really the source of the uncertainty. But I do think if we jump to the next slide, there's also some growing consensus that, I'm sorry, I was thinking the next slide. So I'm going to talk about this, and then I'm going to talk about some of the contrast between the fundamentals and actually what's happening. But that's what's driving the sentiment change. And so what we have here is the AAII U.S. Investor Sentiment. Those are the percentage of investors that are bullish relative to bearish. And, most of the times they do kind of work inversely to one another. Intuitively, you would think if there's more bullish investors, there's less bearish investors. What we saw is a notable spike, and sometimes you actually see those actually even out. We've actually seen some of the most notable shifts actually in recent months. We saw a really stark shift from the number of investors that were bullish to, you can see the number that went bearish really increased in a very short amount of time. It's really just representative of what's happening and why investors and consumers out there are really confused and uncertain about what's going to happen. But we've seen also what's notably happened many times in the past is this can be a very contrarian indicator. So when investors get overly bullish, that's oftentimes when we see a little bit of a correction, and vice versa. And so I wouldn't actually make any stark investment decisions based upon this, especially if we go to the next slide. I want to kind of compare and contrast some of the indicators that are demonstrating that there's just a lot more fear out there than necessarily fundamental weakness. And so we compiled a variety of different stats here. You can see from this that if you go down the list from fiscal policy uncertainty all the way down to Fed policy uncertainty, there's a lot of different indicators that show that heightened level of not knowing what's going to happen. We've seen that spike in VIX that we talked about. We've seen that spike in investment uncertainty. All of that is reflective of just not knowing what's going to happen in the short run. But if we go all the way to the bottom, we look at that Bloomberg IG credit spread, what we're seeing is the actual defaults that are happening and just the widening of credit spreads, which indicate more uncertainty of the health of corporations. It actually continues to be quite low. So there's reason to believe at this stage that we are still fundamentally strong. There's just confusion out there that's driven by the policy uncertainty. So if we fast forward to one more slide here, I'm going to pass it over to Doug, who's going to wrap it up and just summarize it all and take it from there, Doug.
Yeah, and I think, Gary, you did a good job of kind of juxtaposing the positives and negatives. That, I don't want us to come across too negative here in the sense that, from what we can tell so far, the economic data for the most part is still predominantly strong, especially if you look at corporate balance sheets. Fixed income markets tend to be the first areas we see cracks if we're really entering into a difficult period in the economy. So far, corporate credit spreads have remained very tight. They've widened slightly, but nowhere near what you would see historically in the event of kind of the equity volatility we've seen. And I think that's on the heels of corporate balance sheets being really strong. Corporates benefiting from, probably very high margins over the last period of time, great cash flow characteristics, lower debt levels than historical averages. And so I think from if you think about prior crises, we always think about debt being kind of where those bubble up. I think for the most part, the U.S. corporate sector is doing quite well. And that's why I think we've continued to see the resiliency of those spreads. I think corporate earnings so far have come in pretty strong for Q1 or for Q4 earnings reported in Q1. Obviously, we will have to be keeping an eye. There's been a lot of kind of discussion around, outlook. I think some corporates have probably used this volatility as an opportunity to kind of lower their bar for the future. Now, maybe partly due to uncertainty, partly because, don't waste a good crisis, and we can reset the bar a little lower so we can jump over it a little bit in the out quarters. But we are keeping an eye on that. But so far, that is still remains quite strong. I think our outlook for here, until we get kind of more defined data of how these are impacting the economy, is that this is going to be a period of increased volatility. Fortunately, as Gary pointed out in his first market slide, this, I don't want to say for the first time in a long time, but what is good is that the 60-40 or the equity fixed income portfolio is behaving as it historically has, right? The fixed income component is acting as a hedge to some of the drawdowns we're seeing in our equity portfolios. It's also, our fixed income portfolios are relatively healthy in terms of yield. If you think back a decade ago, fixed income was kind of anemic in what it was yielding because we had a 0% Fed policy rate. From here, you're getting attractive yields on cash and other fixed income securities. And so you have the income component that has been a historical, what we expect from our fixed income portfolio. And we've also had that kind of less correlated or uncorrelated return stream relative to equities. And so, for clients who are in kind of a fixed income equity blend, the fixed income portion of the portfolio is doing what we want it to do in these volatile environments. We are keeping an eye on the labor force. That is something that, we touched on. We have seen job openings declining. Where sentiment can be one of those things that is a vicious feedback loop, consumer and business. Whereas if you don't anticipate the future is as rosy as you think it is, you're going to start making decisions around your spending today. And so we are keeping an eye on that, right? We saw in the latest CPI print that airline travel was down, hotel bookings were less robust, rental cars. And so that's something to keep an eye on. There's been a lot of headlines around airlines in their own right around some safety issues. So some of it could be noise. But frankly, travel and entertainment's the first thing that businesses are going to cut before they start laying off people. And so those are economic data points we're looking to as part of our mosaic to figure out, okay, how do all these puzzle pieces come together to affect what do we think will occur over the short, medium, and long term from here? That being said, let's look at some of the positives. Market valuations have pulled back. They've come back to a level that's a little bit less in the stratosphere. This has been a lot of the let's call it gain taking in the Magnificent Seven. A lot of the high flying tech stocks that are now the largest names in the S&P 500 have been those that have given back kind of the greatest amount of return here. And I think that's a lot of people looking at how well they've done for them. They're kind of saying, okay, I'm going to take some chips off the table and I'm going to rotate into some areas that maybe I haven't been as exposed to, like international stocks, like value stocks, areas where they think they're able to pick up a bargain. But what that has done is reduce not only the equity multiples for those great businesses that, like the NVIDIAs and the Apples and the Googles, but it's also, brought the overall valuation level of the S&P 500 down to a more reasonable historic level. Bonds, like I mentioned, are starting from attractive yields here, so we still continue to like the fixed income landscape. We think it's for the corporate balance sheets are healthy. We like the yields we're getting today, and we like that it's performing as we'd expect within a balanced portfolio. And so, for those reasons, we are not, sounding any alarm bells yet. I think what we're trying to do is continue to monitor the situation. We're taking the data as it's coming to us, like all market participants are. But I think what we've seen over the last 2 weeks here is a lot of profit taking, a lot of concern around that uncertainty, and a lot of kind of levered, high frequency market participants just taking their chips off the table. We've seen this in prior crises, that the first move down as fast as that fast money kind of gets out of the way, it usually settles out, and then the market will wait for the data points to inform it of where to go from here. And that's really kind of where we stand today. I don't know, Gary, anything else that I missed that you want to touch on?
I think you summed it up really well. And I think one of the most important things you touched on, I want to just reiterate, is that we're seeing 60-40 portfolios act like they should be. And, now is just a great time to really reinforce that strategic discipline towards a strategic diversification approach. Own assets that are diversified right now. Understand that we are in that period that we can expect more uncertainty based upon the fiscal and monetary environment. But we've been through this before, and a diversified portfolio really does withstand any and all climates. So I think that's honestly the best approach. And we shall make it through this like we do every other period. But at this point, I really just think there is a lot of noise, there is a lot of uncertainty, but a well-diversified portfolio can weather it.
Absolutely, and I just throw one last tidbit in there too. Another thing that these environments and higher volatility do lend themselves towards is we are looking at our portfolios if there's opportunities to tax loss harvest and take some losses to offset some gains. We're certainly actively doing that in this environment. And while that's never a reason, why you want markets to go down, it's certainly an opportunity when that does happen to just make sure we're getting portfolios to their strategic allocations. If we can take some losses, that's great. And so we're always looking for opportunities that the market's trying, the market will give us when there's these bouts of volatility and things might move a little irrationally. So with that, we appreciate everybody joining the March Markets Monthly. We'll see you guys, everybody, next month, and hopefully we'll have more news, more data, a little less uncertainty when we touch base in April. Thank you, everyone.